When I first moved to the US, I didn't really understand a lot of financial terms used here or the different retirement investment options available. Over the years, I have learned a lot, sometimes through trial and error. And now, through this channel, I want to share all that knowledge so that I can help others too. Hi, friends, welcome back to my channel, Your Everyday Economics. This is a place where I simplify money talk for your everyday life. If you are new here, welcome. My name is Parul. Today, I want to talk something that not many people know about, a kind of hidden gem that can actually be used for retirement. It's called an HSA or health savings account. Many people overlook HSA. Now, don't let the name fool you. It is not just used for medical expenses, it can also work like a retirement investment account if you use it smartly. For some of us, this retirement option might be even better than 401k. Yes, you heard me right. It is one of those accounts that a lot of people don't know about, but it can make a big difference in your long term savings, especially for retirement. It's good for people who are generally healthy and don't go to doctor very often or don't have any chronic illnesses. And here's how this works. You can set aside a certain amount of money every year in your HSA, and it's different than FSA because in HSA the money rolls year over year. So if you don't use it for medical expenses, it'll stay in your account and you can even invest it. What's the best part? HSA comes with triple tax advantages, and I will explain to you what that really means. So, who can open an HSA? Well, to open an HSA, you need to meet just one main requirement. You must be enrolled in a high deductible health plan, HDHP. Now, what is a high deductible health plan? A high deductible health plan, HDHP, is a type of health insurance plan that has a lower monthly premiums, the amount that you pay every month to have insurance, but it has a high deductible. And this is the amount you must pay out of your pocket before your insurance starts covering for the medical services. For 2025, that means the minimum deductible is 1650 for individual and 3300 for a family. Now, the maximum out of pocket would be $8,300 for an individual and $16,600 for a family. Now, some people might have some questions about, HSA. So I thought I would answer those in this video. So first is that can anyone open an HSA or do you have to be employed? Yes, as long as you meet the eligibility requirements, you can open one. You don't need to be employed to open an HSA. You can be self-employed, a freelancer, or even unemployed. What matters is that you are enrolled in a qualifying high deductible health plan, and you should not be enrolled in Medicare, and you are not claimed as dependent on someone else's tax return. So even if you buy your insurance through the marketplace privately, you can still open an HSA if your plan qualifies. Now, do all employers offer HSA? Well, not all employers offer HSAs. Some employers offer HDHP with HSA options and may even contribute to your HSA as a benefit, but others may just go with traditional health plans. So, if your employer doesn't offer HSA, you can still open one on your own through a bank, credit union, or HSA provider as long as your health plan qualifies. The next question could be if there are people who may not be a good candidate for HSA. Well, an HSA may not be ideal for everyone. You might want to avoid it entirely. If you have any chronic diseases, in that case, you will end up paying more, out of pocket for prescription services. Now, let's understand how an HDHP plan really works with an example. Let's say Priya has an HDHP with a $2,000 deductible and a $7,000 out of pocket maximum. Her plan only kicks in after she pays the first $2,000 in medical bills herself. If Priya goes to an ER, she gets a medical bill of $5,000. She pays the first $2,000, her deductible, from her own pocket. But after that, her insurance kicks in, maybe covering 80% of the rest. She pays 20% of the remaining $3,000, which is $600. So in total, she has paid $2,600 and insurance covers the rest. If Priya's total medical cost in the year reached $7,000, she wouldn't have to pay anything beyond that because the insurance would cover 100% after that once her out of pocket max is reached. Now, let's understand how HSA gives you triple tax advantage. So, your contribution is tax deductible, which means it reduces your taxable income. Um, Second thing is that it grows tax free, which means there are no taxes on interest, dividends, and investment gains. And thirdly, withdrawals are also tax free for medical expenses. So there are no taxes when you use it for qualified medical cost. You do pay taxes on non qualified medical expenses, which is same as IRA or 401k. Now, let's look at some hypothetical example. Let's say you are 30 years old, okay, and you contribute the maximum allowed for an individual in 2025, which is $4,150 per year. You invest the money in mutual funds inside your HSA. And we assume that your investment earns an average of 7% annually. Now you keep contributing for 30 years without withdrawing. You use the money tax free for medical expenses in retirement. So let's look at the table. So here we have 7% return, taxes paid on contributions, taxes on growth, taxes on withdrawal. As you can see in this table, after first year, your investment grew to $4,441 and you have not withdrawn for any medical use. And then it after 5 years, it grew to 24,229. Given you are still contributing the $4,150 annually. This contribution limit may change slightly annually, but this example is just a simplified version to keep that number constant. So you have contributed 124,500 over 30 years, but your HSA has grown to $400,000. You paid zero tax at every stage for your contribution, your growth, and withdrawal, as long as the withdrawal is done for medical expenses. Now, when we compare this to a 401k, where you pay taxes when you withdraw your money in retirement, HSA comes better. Don't get me wrong, 401k is still a great option, especially if your employers offer a match that is a free money. So, the best way to go about is that first you need to invest so that you get a 401k match. Then you max out your HSA and then go back and max out your 401k or IRA. So, in many ways, HSA is better if you're healthy, you have minimal medical cost yearly, and you can afford to let your HSA grow like an investment account. It's like a secret retirement account hiding in your own health plan. Don't just save your receipts, scan them and store them digitally. You can even reimburse them years later. So, if you have learned something new today, don't forget to like, share, and subscribe to my channel. And please comment below if you have an HSA and if you invest in it so that we can help each other. I hope you have a fantastic day. I will see you guys in my next video. Take care. Bye.